This is a bookable summary of the book The Intelligent Investor by Benjamin Graham. Has the thought of investing in the stock market ever crossed your mind, or have you had other investment plans? For many of us, the answer to these questions is usually yes, but we have failed to take action because of our fear of the financial crises we might have experienced. The intelligent investing procedure was first introduced by Benjamin Graham in 1949, when he proposed that intelligent investing takes a longer-term and risk-free approach to be successful. Since its publication, his approach, as explained in his book, has served lots of people, including business tycoons like Warren Buffett. So what did he say in his book? Number 1. Intelligent investors don't rush in. They take time to rationally examine a company's long-term value. Investment in general has both a positive and negative side. You might have heard stories of successful people like Warren Buffett that earned a lot of money by investing in the right companies, but people have also lost a lot of money by placing the wrong bet. For an intelligent investor, money isn't made simply by just following the market, like buying a stock, just because of a sudden rise in value, or selling a stock simply because its value just dropped. Graham implies that the exact opposite is the case. Intelligent investors observe the market and work based on analysis. They make use of thorough analysis to secure steady profits. This is quite different from speculation, where investors focus on short-term gains which are far riskier. An intelligent investor follows a risk investment process. For instance, if an investor decides to invest in a company because of its new popular product, he may be lucky and make a gain on his investment, or be unlucky and lose on the investment. This is a practical example of the risks investment possesses. As an intelligent investor, you'll buy a stock only if you believe there is a probable margin between what you pay and what you will earn as the company grows. Life as an investor is not always exciting, but making a profit is what makes it count. Number 2. Intelligent investing is broken down into 3 principles. Graham points out an important difference between an investor and a speculator. According to him, intelligent investing consists of 3 principles. First, intelligent investors tend to analyze the long-term development and business principles of the companies they consider investing in before buying any stock. You should not fall into the trap of only looking at short-term earnings, but instead focus on the big picture by checking the company's financial history. This gives you a good idea of how a company performs independent of its value on the market. For instance, a company that's probably not too popular but shows promising records was probably undervalued, and would therefore make for a good investment. Secondly, intelligent investors protect themselves against serious losses by diversifying their investments. They know that it is never a smart decision to put all their money in one stock, no matter how promising the investment is. Lastly, intelligent investors understand that they won't pull in remarkable profits, but rather safe and steady ones. The goal of an intelligent investor is to meet his personal needs, not to outperform the professional stockbrokers on Wall Street. Number 3. Intelligent investors understand the importance of stock market history. Here, Graham again emphasizes the need for investors to look at the history of the stock market before thinking of investing. When you look back at history, you will see that the stock market has always been defined by regular ups and downs, like the Wall Street crash in 1929. These unpredictabilities mean that an investor has to be prepared both financially and psychologically. Being psychologically and mentally prepared means you shouldn't panic to sell everything at the first sign of danger. Instead, you should remember that the market would eventually recover even after the most devastating crashes. Checking the market's history gives you insight into its stability, and once you've determined that market is stable, you can then focus on the history of the company you would like to invest in. Number 4. Don't trust the crowd or the market. To understand how the market operates, it is sometimes easier to imagine the stock market as an individual and call him, say, Mr. Stock. As far as we know, Mr. Stock is very unpredictable, but not very clever. Mr. Stock is easily influenced, and this causes him to have mood swings. We see this by the way the market goes back and forth. When a new iPhone is released, people are excited, and Mr. Stock isn't any different. We see this reflected in the stock market when something exciting is about to happen. Prices go up and people are willing to overpay. The intelligent investor needs to be realistic and stop himself from following the crowd. He should ignore the swings of Mr. Stock because whenever Mr. Stock is happy, he makes you see future profits that don't exist. This means a stock generating profits in a moment doesn't mean it will be profitable forever. Number 5. The defensive investor's portfolio should be well balanced, safe, and very easy to manage. As individuals and investors, Graham advises that we pick strategies that best suit us. Here he talks about the defensive investor. He says the defensive investor hates risks and focuses mainly on safety. She can only achieve this by diversifying her investment. First, you should consider investing in high-grade bonds, such as AAA government securities as well as common stock, in which your share of the company translates to voting power for major business decisions. Stocks and bonds differ in terms of safety and profitability. While bonds tend to be more secure with low profits, stocks do not guarantee such security, but can lead to greater profits. So it is safe to diversify your account for both tendencies. Secondly, you should also consider diversifying your common stock portfolio. You should invest in big companies with a long history of success. You should try investing in 10 of these kinds of companies to reduce risk. And lastly, it is always good to employ the services of experts since they know the game better than you. Number 6. Investing is easy when you follow the formula. After following steps 1 to 5, you are now ready for actual investment. You now have to determine the amount you want to invest regularly and check your stocks from time to time. Graham suggests that you now use the process called formula investing, where you act strictly according to a predefined formula. This will determine how much you will invest and how often. This approach is better explained as a dollar cost average where you invest in a particular stock every month or other specified time with the same amount every time. When you find a steady stock, you will want to set your investment on autopilot. You can start by committing yourself to a certain amount of money you will invest every stipulated time. The merit here is that you wouldn't have to apply further effort, but the disadvantage, however, lies in the emotional demands of formula investing. So even if the price of your target stock is a real purchase and you want to invest more, you have already limited yourself to spending only a limited amount. But the defensive investor checks from time to time to ensure their investment portfolios are running well. So a better rule here is to adjust your portfolio's common stocks and bonds division every 6 months. Lastly, Graham also advises that you should seek the assistance of a professional in the field to discuss adjusting your funds. Number 7. Enterprising investors start similarly to defensive investors. To become a successful investor, you will need to use the same strategy as defensive investors. Just like defensive investors, you could divide your funds between bonds and common funds. But unlike a defensive investor, an enterprising investor would likely invest in common stocks rather than bonds. Although this is much more risky, it guarantees more profitability. Enterprising investors should also talk to professional planners to help them manage their money. Number 8. The enterprising investor doesn't follow the market's ups and downs. What do you do when you notice the price of a stock you own fall and another stock rises? Would it be a good idea to buy it? This approach, known as trading in the market, is typical of investors because they fear that going against the market flow will result in financial losses. However, an intelligent investor knows better. Trusting Mr. Stock is dangerous. If a stock's price is rising fast, then there are chances that it's either more expensive than its intrinsic value, or it will make a risky investment. If you remember the US housing bubble that happened just a few years back, then you will remember that everyone kept investing in housing, and as prices continued to rise, nobody realised that prices were already totally different from their inherent value. Once this became too obvious to ignore, the entire market crashed. So, to avoid this kind of scenario, enterprising investors buy in the low market and sell in the high ones. Check your portfolio from time to time and examine the companies you invest in. Once you realise that one of the companies in your portfolio is overrated and its stock price has risen without any relation to the true value, then it's better to sell your shares off before it crashes. Number 9. The enterprising investor has the chance to find real bargains. At this point, the idea of being an enterprising investor doesn't sound like a fun challenge, but I tell you it is worth it. The best way to start your life as an enterprising investor is to track and pick stocks. Invest virtually for a year, to hone your skill to pick out a bargain and track your stock progress. Today, many websites allow you to make virtual investments. All you have to do is register to see if you will achieve an over-average result. This way you can learn the ins and outs of the investments and also be free from unrealistic expectations. Once you've completed your 1-year virtual experience, then you are ready for bargain hunting. The best place to find a bargain is in undervalued company stocks. The market normally undervalues a stock of companies that are either unpopular or suffering economic losses. So, Benjamin Graham has laid down the golden rules for investing, and I hope you got them and you're willing to apply them. What's your most important key takeaway? Please comment down below and share the video if you like it. Thank you, and until next time.